The amateur who comes to Wall Street is a man obsessed with a single dangerous question. How much money can I make? His mind is filled with visions of vast and rapid profits. The professional speculator, the man who has survived the unforgiving logic of the tape, begins from the polar opposite. His first, last, and most critical question is always, how much money can I afford to lose? This is the great, fundamental dividing line that separates the gambler from the scientific speculator. The gambler is a student of profit. The professional is a master of risk. He understands that in the great game of speculation, the primary vocation is not the making of money, but the relentless and disciplined preservation of capital. For what use is a brilliant market analysis if a single unforeseen event can wipe a man's account clean? What value is a string of small successes if one catastrophic loss can remove him from the game permanently? The art of speculation is the art of survival, and survival is a direct function of one's approach to risk. The single most important decision a speculator makes, therefore, is not what to buy or when to sell. It is how much to commit to any single venture. The key to a long and prosperous career is not a secret formula for predicting the market, but a sound, scientific, and inviolable formula for position sizing. Jesse Livermore, through a lifetime of both triumphant victories and soul-crushing defeats, forged such a formula. It was not a complex mathematical equation, but a set of simple, powerful principles designed to protect him from the two great enemies of a speculator, the market's inherent uncertainty and his own human fallibility. The foundational principles for this professional approach to risk were famously chronicled by Edwin Lefèvre. A link to his essential work, Reminiscences of a Stock Operator, can be found in the description below this video for any serious student of the game. Also in the description is a link for those who find this work of value and wish to support the continued creation of these deep dives through a donation or tip. Your support is what makes this in-depth analysis possible. To grasp the genius of Livermore's formula, one must first understand the amateur's folly. The average man, when he is struck by what he believes to be a great idea, is seized by an impulse to bet everything he has. He gets a sure thing tip, or he becomes infatuated with a particular stock, and he rushes to go all in. He confuses this recklessness with courage. He sees himself as a bold plunger, a man of great conviction. In reality, he is a gambler, placing his entire financial future on a single roll of the dice. He does not understand that on Wall Street there is no such thing as a sure thing. The market is a master of the unexpected. A war can break out overnight. A company's brilliant earnings can be accompanied by disastrous forward guidance. A natural disaster can change the entire economic landscape in a single day. The man who is all in on one idea is a man who is always, at every moment, just one unforeseen event away from complete and total ruin. This is not speculation. It is a form of financial suicide. A professional speculator would no more risk his entire capital on a single trade than a professional general would risk his entire army on a single desperate charge. It is a violation of every principle of sound strategy. The foundation of the Livermore formula, the bedrock upon which his entire risk management system was built, was his famous 10% rule. This rule, as articulated in his own writings, was simple and absolute. A loss on any single speculative commitment must never be allowed to exceed 10% of the capital invested in that trade. But the master speculator applies this rule on a higher level. The true professional understands that the loss on any single trade should not just be limited in relation to the capital in that one trade, but in relation to his total speculative capital. A man with $100,000 in his account might invest $10,000 in a single stock. A 10% loss on that stock would be $1,000. This represents only 1% of his total capital. This is a survivable, manageable, and professional level of risk. But the amateur with that same $100,000 might put $50,000 into that one stock. A 10% loss for him would be $5,000, a full 5% of his total capital. A string of just a few such losses would be devastating. The professional thinks in terms of his total capital. The amateur thinks only of the one trade. Livermore, no matter how bullish he was on a particular stock or on the market as a whole, would never risk a large portion of his entire fortune on a single idea. He knew that his judgment, while excellent, was not infallible. The 10% rule was his insurance policy against his own human error. The first practical application of this risk-first philosophy is found in his method of initiating a position. He never, under any circumstances, established his full intended position at one time. His first move was always a small exploratory one. He would send out a scout, a probe, into the market. The size of this initial bet was deliberately and scientifically calculated to be small. It was a fraction of his intended full line, often no more than a fifth or a quarter of the total amount he was willing to commit to that campaign. The purpose of this probe was to test his own judgment with the minimum possible risk. He had done his analysis. He believed the stock was at a pivotal point and was ready to make a major move. But he did not trust his own opinion. He demanded that the market itself confirm it. The size of this first bet was therefore a direct function of his stop-loss formula. It was calculated to ensure that if his judgment was proven wrong, if the stock moved against him and hit his 10% stop loss, the resulting damage to his total capital would be negligible, a mere flesh wound. This leads to the very heart of the Livermore doctrine on position sizing. The amateur sizes his position based on the strength of his own conviction, on how confident he feels about an idea. This is an emotional and therefore unreliable method. The master speculator sizes his position based on a single objective criterion: the market's own confirmation. His initial probe was small because at that moment he had zero confirmation from the market. He had only a hypothesis, an educated opinion. His position size was a reflection of this uncertainty. The size of his position was then allowed to grow only as the market provided him with proof that his hypothesis was correct. That proof came in one form, and one form only: a profit. This is the essence of his pyramid strategy, viewed through the lens of position sizing and risk management. The size of his commitment was not a static decision made at the beginning of a trade. It was a dynamic process, a direct function of the trade's own performance. His position grew larger only as his profits grew larger. He was not adding to his risk, he was adding to a proven success, and he was using the market's own money to do it. It is in these moments of calculating risk and managing exposure that the true work of a speculator is done. The emotional desire to bet big on a promising idea is a powerful and ever-present enemy. It is the gambler's impulse, and it must be conquered. It is for this reason that a constant study of these first principles is a necessity for any man who wishes to make a profession of speculation. A return to this channel, to this video and others like it, especially after a series of painful losses has clouded one's judgment, serves as a vital recalibration of the professional unemotional mindset. Let us examine the mathematics of the pyramid as a position sizing formula. The speculator, having made his initial probe of, for example, 20% of his intended line, waits for confirmation. The stock moves in his favor, and he now has a profit. This profit is his new risk capital. He can now add the second 20% of his line. His total position is now 40%, but his risk is still being managed. His average cost is well below the current market price, and he has a cushion of profit to protect him against minor reactions. If the stock continues to advance, he will add his third portion, and then his fourth, and so on, until his full line is established. Each new commitment of capital is made only because the previous commitments have been validated by the market. This methodical, step-by-step process of scaling into a position is the polar opposite of the amateur's all-in bet. The amateur takes his maximum risk at the moment of maximum uncertainty, the very beginning. The professional takes his maximum risk only near the end, after the trend has been proven to be powerful and authentic. A critical factor in this formula is the danger of margin. A large position is one thing. A large, heavily margined position is a ticking time bomb, an invitation to ruin. The speculator must always have sufficient capital in reserve, what Livermore called his sitting money. Using excessive margin is a fatal error because it dramatically reduces a speculator's ability to withstand the normal and healthy corrections that are a part of every major trend. A small 10 or 15% pullback, which should be a minor event, can be enough to trigger a margin call. A margin call forces the speculator to sell his position at the worst possible time, often at the very bottom of a reaction, just before the main trend resumes. He is shaken out of a perfectly good trade not because his judgment was wrong, but because his position sizing was reckless. Livermore's formula was inherently conservative in its use of margin. He knew he needed enough financial and mental breathing room to sit tight through the wiggles. His position size was always calculated to allow him to endure these normal reactions without being forced out of the game. The size of his positions was also not a static thing from one market to another. It was a dynamic variable that he adapted to the character of the prevailing market conditions. The formula was not just about the stock, it was about the entire environment. In a clear, powerful primary bull market, a market where the leaders were acting right and the volume was constructive, he would be willing to build much larger lines. The conditions were favorable and the probabilities of success were high. He would press his advantage. But in a tricky, choppy, uncertain, or late-stage market, he would trade with extreme caution. Even if he saw a promising setup, his initial probes would be smaller. He would be far less aggressive in his pyramiding. He might take a quick profit rather than playing for the big swing. The size of his bet was a direct reflection of his confidence not in his own opinion, but in the clarity and health of the overall market environment. When the market offered a clear and powerful tide, he would set a great sail. When the winds were confused and shifty, he would stay close to shore with a small one. This entire approach to position sizing confers a profound psychological benefit. It is the true key to emotional control. A trader who has risked too much on a single trade is a man who cannot think objectively. His every judgment is colored by the intense emotions of fear and greed. He watches every single tick of the tape, his heart pounding. A small move against him feels like a catastrophe. A small move in his favor feels like a deliverance. He is a nervous wreck, not a cool and calculating professional. The trader who has sized his position correctly, whose risk is mathematically limited and fully understood before the trade is ever placed, is a man who is free from this emotional turmoil. He can watch the market's inevitable fluctuations with the calm detachment of a scientist observing an experiment. His mind is clear. His judgment is sound. He can make rational decisions based on the evidence of the tape, not on the spasms of his own adrenal glands. The goal is to always size a position such that one can sell down to the sleeping point, to a level of exposure that allows for a calm mind and a good night's sleep. In the final analysis, the key to Jesse Livermore's genius was not some mystical ability to predict the future. It was his profound and deeply ingrained understanding of risk. He was, first and foremost, a master risk manager. His approach to position sizing was the ultimate expression of this risk-first philosophy. His formula, a synthesis of a hard stop-loss, a small initial probe to test the market, and the methodical pyramiding of confirmed successes, was a complete and scientific system for engaging with an uncertain future. It was a system designed to maximize the profits from his correct judgments while ensuring his absolute survival when his judgments were wrong. The speculator who masters this science of position sizing has mastered the science of survival, and in the great unforgiving game of the market, survival is the first, the most important, and the only non-negotiable form of victory. It is the foundation upon which all great fortunes are built. The amateur chases profit and finds ruin. The professional manages risk, and in doing so, finds his fortune. This is the great, unchanging, and timeless key to the game.